After studying this module, we shall be able to first understand the real and financial implications of current account deficit. Secondly, learn about different patterns of financing current account deficit and their implications. Thirdly, evaluate the importance of foreign exchange reserves under alternate exchange rate regime. Fourthly, identify factors that affect the sustainability of current account deficit. And fifthly, appreciate the complexities facing policy makers in a globalized economy. In this module and in the one that follows, we shall examine new issues and critical issues facing price makers in open economies. With globalization across the world, developing a clear understanding of the implications of international trade and capital flows has become imperative. In particular, we shall discuss certain conceptual issues such as the nature of imbalance associated with current account deficit, factors affecting the sustainability of current account deficit, alternate patterns of financing current account deficit, and the role of foreign exchange reserves under alternate exchange rate regimes, namely fixed versus flexible exchange rate regimes. We had learned about a number of concepts regarding balance of payments, nominal and real exchange rates in the earlier modules. Now we are going to apply these concepts and try to understand the complexities involved in policy making in the era of globalization. So, the second heading of discussion is the implications involved with current account deficits. In this section, we will use the simple national income identity for an open economy that we have discussed in the initial modules to understand the nature of the real imbalance associated with a current account deficit. Thereafter, we shall look at the financial implications of a current account deficit or alternate patterns of financing it and their implications. We start with the real implications. Recall that the current account of balance of payment records payment made to and received from foreigners with respect to a country's trade in goods and services, including factor services with the rest of the world. Using the national income identity for an open economy, we can show that in a country that has a current account deficit, it must be the case that aggregate income falls short of aggregate expenditure or total domestic absorption. This can be shown as follows, like gross national product is equal to gross domestic product plus net factor income from abroad, where NFIA is net factor income from abroad. In other words, we can say GNP, that is gross national product, is equal to consumption plus investment plus G plus NX plus net factor income from abroad, where NX is equal to export minus imports. Or in other words, we can say that GNP is equal to C plus I plus G plus CA, where CA is equal to NX plus NFIA is equal to current account balance. Or in other words, we can say GNP minus summation of consumption plus investment plus government is equal to CA. This is our first equation. We can see from our first equation that a current account deficit or a negative current account balance indicates that there is an excess of aggregate expenditure, that is the summation of consumption plus investment plus government expenditure over income, namely gross national product. The national income identity can further be used to understand whether the real imbalance reflected in a current account deficit stems mainly from the private sector or the government sector or both. We know that gross national product is equal to consumption plus investment plus government plus CA. Deducting consumption expenditure and total taxes from both sides, we get, that is GNP minus C minus taxes is equal to C plus I plus G plus CA minus C minus T. This will give us the SP is equal to 1 plus CA minus within bracket T minus G, where GNP minus C minus T is equal to SP is equal to private savings. Or in other words, we can say that Sp minus 1 plus T minus G is equal to Ca. This is our second equation. The relation represents the twin deficits, with an external deficit being mirrored either in the private sector, that is Sp minus 1, or the government sector, that is T minus G, or in both. We can see from second that a current account deficit, that is current account is less than 0, reflects either an excess of private investment over private savings, that is Sp minus 1 is less than 0, or a budget deficit, that is T minus G is less than 0, or both. Also in situations where, for example, Sp minus 1 is greater than 0 but T minus G is less than 0 and absolute value of T minus G is larger than Sp minus 1, there would be a current account deficit. The main point one should note from the identities 1 and 2 above is that there is an imbalance in the real economy whenever a country runs a current account deficit. In all such cases, there is an excess of aggregate expenditure over income. This may occur in any of the following cases: private savings are too low, or there is an investment boom in the economy, or the government is running a budget deficit, or some combinations of these factors. Then we have the second implication is financial implications. Note that a country with a current account deficit is essentially a debtor country that has to borrow from the rest of the world to cover the excess of the aggregate expenditure over income. The financial implications of a current account deficit essentially relate to the pattern of financing such deficits. Recall our discussion in balance of payment accounts that a current account deficit is financed by a combination of net capital inflows and a change in foreign exchange reserves. The capital inflows may be debt creating, for example, external commercial borrowings, or net debt creating, that is foreign direct investment, or foreign portfolio investment, long term and stable, for example FDIs, or short term and volatile, for example FPI in nature. In general, FDI is a preferred form of foreign capital inflow in most cases, as it tends to be long term in nature and is often associated with productive investments in the tradable sector that can potentially create future capacity for earning foreign exchange, for example via exports. In case of India, FDI involves a foreign firm acquiring 10% or more equity in a domestic company. Purchase of equity essentially gives part ownership right to the holder, and when a foreign firm makes sizable investment in a domestic company, it is expected that these funds would be stable and not be withdrawn at short notice. However, unlike FDI, FPI involves short-term capital flows that are often extremely volatile in nature. Much of the FPI inflows into equity market in emerging economies like India came from foreign institutional investors like pension funds, mutual funds, investment banks, etc. in the developed markets. The FPI inflows enter emerging markets seeking higher returns compared to the relatively low returns in the developed country markets. Typically, such funds are very volatile as they are quick to respond to arbitrage opportunities in markets across the globe. Such inflows are called hot money due to their volatile nature, and they are considered highly unreliable as a source of financing current account deficits. Country experiences indicate that at time of crisis, hot money is withdrawn, leading to massive capital outflows and sharp currency depreciation and abandoning of exchange rate pegs. We will discuss some specific country experience in the next modules. External borrowing is another common option used by countries to finance current account deficit. The main difference between capital inflows associated with external borrowing and FDI or FPI is that external debt has to be repaid with interest, and most often for emerging economies. Such debt is denominated in foreign currency, that is, if $100 is borrowed, at maturity the $100 has to be repaid with interest and not simply the rupee equivalent to the amount that was borrowed. So if the home currency has depreciated sharply in the meantime, it would substantially add to the cost of servicing the external debt in rupee terms. Another problem associated with external debt is that in case foreign creditors suspect that a crisis is looming over there or there is chance of default, they would not roll over the existing stock of debt and call in the loans they have extended. In such cases, their debt creating capital inflows would come to a sudden stop and countries would find it very hard to finance deficits. They may even have to drastically reduce imports to bring down the trade deficits when faced with such situations. Further, firms with substantial external debt on their balance sheets experience a worsening of their financial position if the domestic currency depreciates, making servicing of external debt more costly. In such cases, firms may even be forced to shelve expansion plans and cancel fresh investment decisions as their profits are squeezed. In case a country experiences net capital outflows or in case net capital inflows fall short of the current account deficit, it has to be financed by drawing down foreign exchange reserves maintained by the central bank of the country. The role of foreign exchange reserves in financing deficits must be understood in context of the exchange rate arrangement that prevails in a country. So we'll have more to say about this as we discuss alternate exchange rate system in the next section. Now we move on to the discussion of different exchange rate regimes. In the previous modules, we have learnt what is meant by the concepts of fixed and flexible exchange rate regimes. We are now going to examine few implications of alternate exchange rate arrangements, especially from the point of view of maintaining foreign exchange reserves. When an economy has a perfectly flexible exchange rate system, it has no need for foreign exchange reserves. This is because exchange rate flexibility ensures that demand for foreign exchange is equal to supply so that BOP is always in equilibrium. In case of excess demand for foreign exchange, excess supply of domestic currency, the foreign currency will appreciate, the domestic currency will depreciate till equilibrium is restored in the foreign currency market. At the other end of the spectrum, we have the fixed exchange rate system, where the country must maintain adequate reserves so as to assure market players that it can maintain the existing fixed parity. A country's stock of foreign exchange reserves play a critical role when it adopts a fixed exchange rate, as the central bank must stand ready to sell foreign exchange at the fixed rate. In case against suspect that the central bank may not have adequate reserves to defend the parity, there would act a run on the domestic currency. That is, in this case, agents would scramble to convert this domestic currency into foreign currency, fearing an imminent devaluation that would make foreign currency dearer in the near future. Typically, in such situations, expectations tend to be self-fulfilling as fear of devaluation leads to a run on the domestic currency and a steady loss of foreign exchange reserves. In such cases, the central bank may be forced to abandon the fixed parity and announce a devaluation. In many cases, it also imposes restriction on capital outflows and import controls to stabilize the foreign exchange market. In particular, fixed exchange rate systems tend to be crisis prone, as borne out by country experiences. We'll discuss a few such experiences in the next module. The most common exchange rate arrangement in the world today is that of a managed float, which lies somewhere in between a perfectly flexible and a fully fixed regime. Under such a system, the exchange rate is allowed to fluctuate within a certain band and the central bank uses foreign exchange reserves to intervene whenever it appears that the domestic currency might breach the limits. Therefore, maintaining adequate foreign exchange reserves is of utmost importance for most countries today. But how much is adequate? This question has no easy answer applicable to all countries under all circumstances. However, there is a cost of maintaining too much foreign exchange reserves as these do not carry any return. Typically, countries' foreign exchange reserves are held in the form of hard currencies, for example, dollars or euros, or as safe, liquid and low yielding assets like US Treasury bills. Nowadays, many countries have opted to float sovereign wealth funds, wherein part of the reserves are used to hold relatively high yielding long term returns. However, One problem with such kind of SWF relates to the associated liquidity risk, that at a time of crisis they may not be available, or it is not easy to sell them in dollars as readily as the stock of foreign exchange reserves. Another aspect of foreign exchange reserves relate to the impact they have on the money supply. Recall from our discussion in previous modules that ceteris paribus, an increase in foreign reserves lead to an increase in high-powered money and in the money supply. Via the money multiplier, central banks have the option of sterilizing foreign exchange interventions to neutralize the impact of change in reserves on the money supply. How it exercises this option under fixed and flexible exchange rate system is a topic that we'll discuss in the next module. Now we move on to discuss sustainability of current account deficit. In the context of our discussion, we'll now discuss some of the factors that affect the sustainability of current account deficit, especially in the context of emerging economies like India. The current account can be expressed as current account is equal to SP minus I plus T minus G. This clearly indicates that a country may experience a current account deficit owing to a fall in private savings or an increase in national investment or due to an increase in the budget deficit. What can we say about the sustainability of the deficit in each of the cases? A fall in private saving rate may be transitory and occur when expectations of higher future GDP growth lead to an excess of current consumption over current income. In such cases, the level of private saving rate would recover when income increases in the future. Thus, a current account deficit caused by decrease in private saving may not persist and may even be reversed. When there is a boom in domestic investment, this tends to spill over to the external sector via higher imports, leading to widening current account deficit. Financing the deficit might lead to accumulation of foreign debt. However, such current account deficit may not be unsustainable. If the investments are productive and concentrated in the tradable sectors, they would create future capacity to earn adequate foreign exchange for repaying foreign debt. However, if the investment boom is mostly speculative and unproductive in nature and concentrated in the non-tradable sector, for example housing, then there might be a problem. As such, investment may not augment the country's potential to earn foreign exchange. In this case, servicing foreign debt may be problematic in the future, especially in case of persistent current account deficit. A current account imbalance caused by a large budget deficit may result in huge accumulation of sovereign external debt, which might lead to an unsustainable current account deficit. In emerging economies like India, with a large population of poor people, often government expenditure is high due to spending on social sector schemes, subsidies, etc., that may not have immediate returns, especially in terms of enhancing the country's foreign exchange earnings. Fiscal stimulus by government also tends to boost aggregate demand and hence imports, leading to widening external deficits. For all these reasons, many economies are of the view that controlling budget deficit would be a top policy priority, especially in a globalized economy. Apart from these factors, sustainability of current account deficit also depends on other macroeconomic factors like the growth rate of the economy, the size of the current account deficit, and the degree of openness of the economy. A high growth economy is likely to have relatively high productivity and an efficient production structure. Such an economy would have a relatively high potential to earn foreign exchange that would in turn make its current account deficit sustainable. In fact, the degree of openness of the economy may also have a bearing on the size of the current account deficit. A high growth open economy with high rate of growth of exports may have high current account deficit, but this would tend to be more sustainable compared to a high growth economy where growth is based on domestic consumption. In the latter case, import growth would be high and current account deficit may be unsustainable, especially if export growth is sluggish. What also matters in this context is the size of the current account deficit relative to GDP. If this is too high, then the deficit may be unsustainable. In fact, according to Lawrence Summers, US Deputy Treasury Secretary, a current account deficit of more than 5% of GDP may be dangerous, especially if it is financed in a way that could lead to rapid reversals. Another factor that affects the sustainability of the current account deficit is the pattern of financing that prevails. In particular, the composition and size of the capital inflows, the composition and the different things and the extent of external debt and the size of foreign exchange reserves have important implications for sustainability. Based on our discussion in the previous sections, it can be said that if capital inflows constitute FDI rather than FPI or external debt, and if economy has adequate foreign exchange reserves, that is reserve equivalent to at least 3 months import bill, this would be a fairly sustainable pattern of financing current account deficit. In general, if the stock of international debt is huge and a large fraction consists of short-term debt, this will make the current account deficit unsustainable. Especially in case an external crisis, for example currency crisis, when there is panic in financial market, foreign creditors would be unwilling to roll over those loans. In fact, the currency crisis can lead to external debt crisis in this case. If the country has a large stock of foreign reserves, it would be better equipped to deal with such external crisis. Thus, a large foreign exchange reserve and a relatively small stock of international debt tend to make the current account deficit more sustainable. The sustainability of current account deficit may also be affected by capital inflows in the following way. When an economy has large capital inflows in excess of its current account deficit, so that is there is BOP surplus, this may lead to appreciation of the domestic currency. Currency appreciation may reduce the competitiveness of domestic exports and thus in the long run make the current account deficit unsustainable. Apart from the above, the soundness of the domestic financial system, especially the banking sector, has a crucial role in financing current account deficit. Financial stability is an important factor in attracting capital inflows into a country as it affects the stability of financial returns on the domestic assets. Any sign of financial instability tends to restrict inflow of foreign capital necessary for finance current account deficits. Alongside, political instability and uncertainty regarding economic policy also has a negative impact of capital inflows, especially FDI inflows and financing of deficits. Political stability and adoption of sound macroeconomic policies affect the credit rating of the country. In case a country's credit rating is downgraded, it would raise the cost of external borrowing for domestic agents and also make it difficult for the country to attract FDIs. Sustainable option for financing current account deficit would be reduced in such situation. The above analysis highlights the condition under which a large current account deficit may be sustainable. It especially suggests that there is nothing inherently good or bad about a current account deficit. So, a current account deficit and the ensuing accumulation of foreign debt may be sustainable and lead to higher long run growth, or may be eventually unsustainable and lead to a currency and debt crisis depending on what derives the current account deficit and how it is financed. Now we are going to make a summary of what we have discussed so far. We have started our discussion with the introduction of current account deficit. When a country runs a current account deficit, excess of aggregate expenditure over aggregate income, it is converted into current account deficit. Then we have discussed the reasons of current account deficit. The current account deficit may be due to an excess of private investment over private savings, or due to a budget crisis, or both. Then we have discussed the implications. The financial implication of current account deficit relate to the way the deficit is financed. Debt creating or non-debt creating capital flows may be used to finance the current account deficit. We can say that in general, too much reliance on external debt is not advisable, as this may be problematic in times of crisis, when external debt has to be repaid along with interest. At that time, the external debt becomes costly and fresh debt may not be available and existing debt may be required to be called off. Foreign exchange reserves play an important role in financing the current account deficit. The role of foreign exchange reserves is especially important when countries adopt a fixed exchange rate and when the exchange rate is on a managed float. Several factors affect the sustainability of current account deficit, including what drives the deficit and the pattern of financing the deficit. Current account deficit tend to be relatively more sustainable in the presence of financial stability, political stability, and sound macroeconomic policies.